Coupang is often called the Amazon of South Korea, but the stock has performed poorly, falling 75% since its IPO. At the latest share price, the company has a market cap of $27 billion, account for cash and debt, and the enterprise value is $22.8 billion. That's less than the company's annual revenue, which totals $23 billion over the last 12 months. Adjusted EBITDA over the same period is $991 million, and free cash flow is $1.8 billion. So Coupang stock looks cheap at under 1 times revenue and only 12 times free cash flow. Amazon, by comparison, trades at 3 times revenue and 100 times free cash flow. However, Coupang deserves a lower multiple to Amazon because Coupang lacks Amazon's high-margin segments like cloud and third-party services. Also, Coupang's free cash flow is inflated this year due to working capital movements that are a one-off. Free cash flow should converge with adjusted EBITDA over time, so the true multiple is closer to 22-23. That valuation, however, is still reasonable. After all, Coupang has gone from zero revenues to over $23 billion in only 14 years. Even faster than Amazon, and this year's revenues are up 14% despite a difficult economic environment. Coupang has also built out a logistics network that is on track to surpass market leader CJ Logistics. According to the Korea Times, CJ has conceded at least 6% of market share to Coupang over the past few years. Despite those achievements, investors are clearly skeptical of Coupang's chances. Strong competition comes from the likes of Naver, AliExpress, and potentially Temu. Well-capitalized rivals could take market share or put pressure on margins. Those fears were amplified in the most recent quarter. Coupang reported a 21% increase in revenue, but earnings declined sequentially and were flat year over year. Sustainable profits is the big issue right now for investors. Without a high-margin business like Amazon Cloud, Coupang is left with relatively thin profit margins and revenue growth that will likely slow down in the not-too-distant future. As a result, the company continues to invest in new ventures like food delivery, and it's attempting to expand in Taiwan. These ventures make it hard to predict when Coupang will start to produce consistent profits. Let's assume that Coupang can grow its top-line revenue at 10% a year for the next 5 years and operate with a 10% EBITDA margin, which is a significant improvement from current levels. Apply a 15 times multiple to that and the valuation gets to $56 billion. Account for cash and some dilution and the annualized return could hit 17% per year. That return looks tempting, but investors need to hope that Coupang doesn't throw too much money on unprofitable ventures. I rate the stock a cautious buy, but these are my personal opinions, not financial advice, and I've got no position in Coupang stock. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.